Welcome to Talk Tickers. Today we're taking a deep dive into Silvaco's recent Q2 2025 conference call. They're a small cap player, in the EDA and TCAD space.
Right, and this call, it was after hours, August 6th. It kicked off a pretty immediate and, frankly, steep market sell-off.
Yeah, a really negative reaction.
Exactly. So the mood was, let's say, cautious even before management spoke, and it certainly didn't improve right after.
Absolutely. So our job now is really to sift through what was said. We need to figure out, first, was that pessimism justified by the actual numbers, the fundamentals? Mm-hmm. And second, how credible is this, incredibly aggressive path they laid out for the rest of the year? Is there a real recovery roadmap here?
Precisely. And let's start with the big headline, the numbers that really seemed to shock the street. They were difficult, to put it mildly.
Okay, let's unpack just how big that miss was.
It was huge on the earnings side. Silvaco reported a non-GAAP EPS of negative 16 cents, minus 16 cents.
Wow.
Yeah, and that missed the consensus expectation by, get this, 77.8%, nearly 80%.
That is staggering for a software-type company in this space.
It really is. That kind of surprise. It screams problems.
And usually a miss that big comes with revenue issues too, right?
You guessed it. Revenue came in pretty light at $12.05 million.
Okay, 12 million. How does that compare?
Well, that's down 19% compared to last year, 19% year-over-year decline. And it fell short of what analysts expected by about 15%.
So not just a small miss. This was a fundamental misstep relative to the model.
Definitely not minor. And the market saw it that way, too.
Right. The stock action tells the story. It dropped instantly after hours, over 6%.
Over 6%, yeah. And then the next regular trading day, it closed down almost 15%.
Okay, so that 15% drop is the backdrop for this whole discussion. Management basically had to spend the call explaining why things weren't falling apart.
Exactly. So to understand why it happened, we need to look under the hood, find the source of the weakness. And that really points to their traditional core business, TCAD.
Technology Computer-Aided Design.
That's the one. GAAP TCAD revenue was $6.8 million. That's down a brutal 34% year over year.
34%. Ouch. What was the reason they gave?
Management pointed to timing. They said large renewals got pushed out, cyclical stuff impacting customer POs, basically blaming delays into Q3 or Q4.
Okay. The classic timing excuse. So if TCAD was that weak, did anything else perform well? They needed something to offset that, surely.
There are some bright spots, and actually they're key to the whole strategy pivot we'll talk about. The smaller segments did show growth.
Like what?
EDA, that's electronic design automation revenue, grew 15% year over year, came in at $3.4 million.
Okay, 15% growth there.
And SIP, the semiconductor IP segment, that grew 11% year over year to $1.8 million.
So good momentum in EDA and SIP, but obviously not nearly enough to make up for that huge TCAD drop.
Not even close in Q2.
And I assume the bookings, the forward-looking stuff, reflected that same caution management mentioned.
It did, yeah. Gross bookings were $12.9 million, down 34% year over year.
Wow, okay, that matches the TCAD revenue decline almost exactly. That's a big drop in future visibility.
It is. Now, they did give the RPO number, remaining performance obligations. That stood at $36.4 million.
Okay, $36 million in RPO.
And they said about half of that, roughly 50%, should turn into revenue in the next 12 months. It's something, but you want to see a much bigger backlog given the current weakness.
Makes sense. Okay, let's shift to the income statement pain points. Margins. Non-GAAP gross margin dropped sharply to 76%. That seems quite low compared to where they've been.
It's a big drop. And it's really classic operating leverage working in reverse here.
How so?
Well, their cost of goods sold, R&D, some operational stuff, it's relatively fixed. So when your revenue suddenly drops by almost 20%.
But the costs stay the same.
Exactly. The margin percentage just gets crushed. That was the main driver.
So mostly the volume shock.
Mostly. Though they did also mention some initial integration costs from buying PPC and TechX. Those acquisitions added a bit to the KakoGS line as they brought them on board.
Got it. What about cash? Did the quarter burn through a lot?
They ended Q2 with $55.5 million in cash and securities. That is down from Q1.
Why the drop?
Two main things they called out. Settling that NAND gate lawsuit and paying for the TechX acquisition.
Ah.
And importantly, they gave a forward look too. They expect pro forma cash, so after the Mixel deal closes fully, to be somewhere in the $30 to $35 million range.
30 to 35 million. So they are definitely spending on M&A.
Aggressively.
Yeah.
It confirms that M&A focus.
Okay, let's pivot to maybe the most interesting or perhaps concerning metric they pushed. Management really emphasized TTM ACV, trailing 12-month annual contract value.
Right, they presented it as a better indicator of health. And TTM ACV grew 26% year over year.
26% sounds great, right? Healthy growth.
On the surface, yes. But this is where you have to listen really carefully. Management's own disclosure kind of pulls the rug out from under that number.
Yeah.
They admitted that organic growth, the growth from their existing business selling more, only contributed about 1% to 2%, quarter over quarter to that ACV increase.
Wait, say that again, 1 to 2% organic?
Just 1 to 2% quarter over quarter organic contribution. Let that sink in.
So almost all of that 26% year-over-year growth came from buying other companies.
Precisely. Over 90% of the growth was acquired via M&A, not generated internally.
Wow. Okay, that's a massive red flag, isn't it?
Yeah.
If you're positioning as a growth company, 1-2% organic ACV growth is basically flat, stalled.
It absolutely confirms the idea that the organic engine has slowed dramatically. M&A isn't just part of the strategy right now. It seems to be the only thing driving significant growth.
Which crystallizes their whole narrative on the call then.
Exactly. The story isn't about strong organic performance. It's about using an aggressive M&A flywheel to buy growth, specifically to counter the macro headwinds and their own slowdown.
They're bolting on scale.
That's the plan, force growth through acquisitions.
So let's talk about those deals, because they're redefining the company now, targeting AI, photonics, automotive, high growth stuff. And they just closed the Mixel deal, right? August 1st?
Yes, Mixel closed August 1st. That's a big one. They do mixed signal IP, think high-speed connectivity, interfaces, display drivers.
Crucial for things like AI chips in cars.
Exactly. And that deal alone, they said, adds $110 million to their serviceable addressable market, their SAM.
$110 million just from Mixel. And what about the total impact from all the recent deals?
The total SAM expansion just from the 2025 acquisitions, PPC, Tex, Mixel, is over $710 million.
$700 million added to the SAM.
Yeah, it takes their total SAM from about $3.8 billion last year to $4.5 billion this year. It's a huge deliberate shift in strategy.
So they're moving way beyond just being a TCAD provider.
Absolutely. They're building a much broader EDA plus SIP platform. PPC and TechX brought IP for power electronics, advanced sensors, specialized TCAD, stuff they can now cross-sell into these new markets.
And did they mention any wins? Proof that this strategy is working.
They did highlight resolving that NAND gate legal issue, which is good. And they claimed 10 new logo wins across these key areas.
Like where?
3 in photonics, 1 foundry, 2 in power, plus Mil-Aero automotive. So yes, some validation that customers are interested in the new broader portfolio, even while the legacy TCAD side struggled in Q2.
Okay, which brings us to maybe the most controversial part of the call.
Yeah.
They reiterated full year guidance. After that Q2 disaster, how?
That's the million-dollar question, isn't it?
Yeah.
They are banking, completely banking on a massive snapback in Q3 and Q4.
Believing those delayed Q2 deals will definitely close.
That's the narrative. Delayed POs closing plus immediate synergies from the acquisitions kicking in.
What does that Q3 guidance actually look like?
Ambitious doesn't quite cover it. Revenue guided to $14 to $18.0 million.
14 to 18 million. What was Q2 again? 12?
Q2 was $12.05 million. So to hit the midpoint, $16 million, they need a 33% sequential jump. To hit the high end of $18 million, they need almost a 50% jump. Quarter over quarter.
50% sequential growth.
Wow.
And margins.
They expect non-GAAP gross margin to bounce right back up to the 81-85% range. A huge recovery.
Wait a second. How realistic is that? Given the macro environment, a 34% drop in TCAD bookings suddenly reverses in 90 days? Doesn't that sound like hope? Like trying to keep investors calm?
It absolutely stretches credibility. And the market reaction clearly showed that skepticism. Nobody seemed to believe it initially.
And full year.
Still aiming for $64-70 million in revenue, $67-74 million in bookings. And crucially, they reiterated being free cash flow neutral for the year.
Hitting those numbers, especially FCF neutral after that Q2, it requires flawless execution in Q3 and Q4. Zero room for error.
Absolutely zero.
Not that bad.
But there's a huge development that happened after the call, something that changes the execution risk calculation significantly.
Oh, what's that?
The CEO transition. On August 21st, they announced Wally Rhines is taking over as CEO.
Wally Rhines from Mentor Graphics.
Wally Rhines, yes. For anyone in the semiconductor or EDA world, that's a name that carries immense weight.
Okay, that is a big deal. That's a major leadership upgrade.
Huge upgrade. And the timing is perfect for this M&A heavy strategy. Rhines ran Mentor Graphics for decades, grew it massively, handled complex integrations. He knows large-scale EDA inside and out.
So bringing him in isn't just a change, it kind of validates this bigger ambition, right? He wouldn't join a sinking ship or a flawed strategy.
That's the signal, yes.
Yeah.
It suggests they're serious about becoming more than just a niche TCAD player. Getting Rhines brings the operational credibility needed to actually execute this complex M&A integration plan with PPC, TechX, Mixel.
It's probably a key reason the stock didn't just keep cratering after the Q2 results. Investors might be betting on him now.
I think that's a big part of it. They're betting on the new sheriff to get the backlog converted and make these acquisitions work.
Okay, so we're at this really interesting split point. A terrible Q2 print confirming organic weakness, stock gets hammered. But then management, now led by an industry legend, sticks to this incredibly optimistic forecast based on M&A and a sharp recovery.
Exactly, and the backdrop isn't easy. The broader semiconductor sector, the SOXX ETF, software index IGV, they've mostly rallied quite strongly into the second half of 2025. Silvaco has lagged way behind.
So the pressure to execute is even higher now because the rest of the market is moving.
Right, the bar is raised. The whole investment case now boils down to two things, really.
Oh, sure.
One, can they actually close those delayed purchase orders from Q2? Is that revenue really just pushed out, or is some of it lost?
Okay, converting the backlog.
And two, can they quickly integrate PPC, TechX, and Mixel and actually start cross-selling effectively? Can they monetize this new, much bigger IP portfolio?
It's a total narrative shift. Forget just TCAD cyclicality.
It's now about being a broader EDA plus SPP platform for AI, HPC, photonics, all the hot areas. Closing that valuation gap with peers, it all depends on executing this Rhines-led expansion.
All right, perfect setup for our highly speculative, definitely not financial advice segment. Give us the outrageous but plausible trade idea based on this whole situation.
Okay, so the market absolutely hammered the stock on the Q2 miss. But then it stabilized, partly on the Rhines news. There's still a ton of skepticism baked in, especially about that Q3 guide, the $14 to $18 million range.
The street doesn't buy the snapback?
Not fully, no. So the trade idea is basically a bet against that deep skepticism, a play on them actually executing reasonably well in Q3.
Leveraging the Rhines honeymoon period and maybe those delayed deals.
Exactly. The pitch is this. The combination of a new, respected CEO wanting to make a good first impression, plus the high likelihood that some of those delayed Q2 orders simply have to close in Q3. It creates a decent chance they beat the low end of expectations for Q3 revenue.
Okay, so how do you structure the trade?
It's a volatility play. Structure a bullish call spread expiring just after the Q3 earnings are announced.
Okay, bullish call spread. Break that down.
You buy call options at a strike price around the midpoint of their Q3 guidance, say, betting they hit $16 million or maybe a bit better.
Right.
And at the same time, you sell call options at a higher strike, maybe above the high end of their guidance, like $19 or $20 million perhaps.
And selling the higher calls reduces the cost of buying the lower ones.
Exactly. It lowers your cost basis. It's a defined risk bet squarely on management under Rhines, successfully converting enough backlog to make Q3 look much better than feared. It's a bet on near-term execution.
A high-stakes bet on that Q3 print. Got it. Okay, so let's recap. Q2, a clear disappointment. Confirm the organic growth engine is sputtering and macro delays hit bookings hard.
But the whole story now pivots on the response. Aggressive M&A, like Mixel adding Big Sam, and that really crucial leadership change to Wally Rhines.
Right, so the fundamental question for anyone watching this stock, the thing that defines the next 6 months is,
can this rapid shift from being just a TCAD player to this broader EDA plus SIP platform actually work? Can Rhines execute fast enough to deliver that incredibly ambitious sequential recovery in Q3?
That's the key. We definitely encourage you to watch those execution points very closely, especially how much of that delayed Q2 business actually shows up in Q3. Thanks for diving deep with us on Talk Tickers.